If you're earning good money in the UK right now, and I mean properly good money, and you're still relying on the same investment playbook from 5 years ago, you are falling behind. Not slowly, fast. I spent over 5 years as an investment specialist at HSBC Private Bank in Geneva, managing portfolios for some of the wealthiest people on the planet. I then moved into a family office in the Gulf doing the same thing. And what I'm about to share with you in this video is the exact framework I use to build portfolios for millionaires and billionaires, adapted for you right here in the UK in 2026. We're going to cover where to put your money, how to protect it from the tax machine, and why the traditional approach alone is no longer enough, and what the smartest investors I've ever worked with are doing about it. Quick disclaimer, this is not financial advice. I'm sharing what I do and what I've seen work. Your capital is at risk. Always do your own research. Let's get into it. Let me paint you a picture. You're earning over £100,000 a year in the UK. Sounds great, right? Let's see what actually lands in your pocket. Income tax and national insurance take a massive chunk. If you're between £100,000 and £125,000, you're in that brutal 60% marginal tax band, where you're losing your personal allowance. Then council tax, student loan if you've got one, and then inflation, which has been running hot for years now, quickly hits what's left. By the time you're done, that £100,000 doesn't feel like £100,000. It feels like you're running on a treadmill that keeps getting faster. Now here's the bit that really matters for investors. For years, the standard advice was put your money in a global index fund, earn your 8 to 10% average annual return, and let compounding do the work. And that advice isn't wrong, it's the foundation. But when taxes and inflation are combining to take 40, 50, sometimes 60% of what you earn before you even get to invest it, that 10% return is not the finish line anymore, it's the starting line. This is the reality for high earners in the UK in 2026. And if nobody's told you this yet, I'm telling you now. Before I show you how to push beyond that ceiling, the foundation has to be right. Without this, nothing else matters. In the UK, the government gives you 3 accounts to invest through, and the order matters. First, your stocks and shares ISA, £20,000 a year, and everything inside it grows tax-free. No capital gains tax, no dividend tax. If you're a earner and you're not feeling this every year, you're leaving money on the table. Second, your pension, SIPP or workplace scheme. You put in £600, the government tops it up to £1,000. That's 40% tax relief. It's as close to free money as it gets, and you can put it up to £60,000 a year. Most people I talk to are nowhere near that number. Third, a general investment account. This is for anything beyond your ISA and pension limits. It's flexible, but you will pay tax on gains, so it's the last one you fill, not the first. Now what goes inside these accounts? The same thing I built for a client managing tens of millions, a global index fund. One investment that spreads your money across thousands of companies in 40 to 50 countries. You're not betting on one country or one sector, you own all of it. Over the past century, the global stock market has returned roughly 8% a year before inflation, around 5% after. Through wars, crises, pandemics, it kept compounding. The track record earns the right to be the core of your portfolio. So ISA first, pension second, global diversification inside both. That's not my opinion, that's wealth management one-on-one. It's what we did at HSBC Private Bank for clients worth 8 and 9 figures. But here is where it gets interesting. If you're a high earner watching this, you already know the math doesn't feel right. You're doing the right things, ISA, pension, index funds. And yet the gap between where you are and where you want to be isn't closing fast enough. That's because the environment has changed. Inflation rate at level we hadn't seen in 40 years. The UK tax burden is at its highest since the post-war era. And if you're earning over £100,000, you're being squeezed harder than almost anyone. A 10% return sounds great until you realize that after inflation and the tax drag on anything outside your ISA, you might be netting 3 to 4% in real terms. On a £50,000 portfolio, that's £1,500 to £2,000 of real growth a year. For someone earning 6 figures who wants to be real wealth, that's slow. So what do? You don't abandon the foundation, you add a growth engine on top of it. Let me take you back for a second. I was working at HSBC Private Bank in Geneva. My job was to build and manage investment portfolios for ultra high net worth clients in the Gulf markets. We were talking serious money, and the strategy was always the same. Diversification, strategic asset allocation, quality assets, long-term horizons. The playbook that's worked for decades, but something started shifting around 2019. Clients began asking me about Bitcoin, about digital assets. Not retail traders looking for a quick win. These were sophisticated investors, business owners, family offices. They wanted exposure, and they had good reason to want it. I looked at the data myself and it was hard to argue with. Bitcoin had been the single best performing asset class in 10 out of the last 12 years. But here's the problem. The institution couldn't deliver it. The banks, the traditional wealth management firms, they were too slow, too cautious, too old school. My clients were asking for something I believed in, and I couldn't give it to them. And then in 2024, something happened that I will never forget. One of our clients, a billionaire, one of the most respected names in finance, started buying Bitcoin. Not a small allocation, £3 million every Monday, week after week, month after month. When someone at that level with that kind of financial sophistication is making that kind of commitment, it sends a signal. And that signal echoed through the bank in a way I'd never seen before. The old school thinker had to pay attention. That was my moment. months, I realized the gap in the market was enormous. Earners, professionals, people earning 100, 200, 500,000 pounds. They wanted to add this growth engine to their portfolios, but nobody was helping them do it properly. Not with a plan, not with the same rigor and discipline you'd get at a private bank. So I left. I started Dextton, and now I help people in the UK do exactly that. Now, I need to be very clear about something. When I say crypto, I don't mean gambling on the next meme coin that someone on Twitter told you will do 100x. That's not investing, that's speculation, and most people lose money doing it. What I mean is using institutional quality digital assets, primarily Bitcoin and selectively other established protocols, as a deliberate size allocation within a diversified portfolio. The same way you'd add emerging markets or commodities or real estate. It's an asset class, treat it like one. The exact allocation depends on your risk profile, your goals, your time horizon. For some people, it's 5%. For others, it's 15 or 20%. But the principle is always the same. Quality assets only, properly sized within a strategy that makes sense for your life. Here is why it matters as a growth engine specifically. When you layer even a modest crypto allocation on top of a well-built traditional portfolio, the impact on long-term returns is significant. Because you're not replacing the foundation, the ISA, the pension, the global index funds. You're turbocharging it. Think of it like this. Your ISA and pension are the engine of your car. Solid, reliable, gets you where you're going. Crypto done properly is a turbo. It doesn't replace the engine, but it gets you there meaningfully faster. And the beautiful thing is, this isn't theory. I've seen it work. Take Francis. He came to me holding a significant amount in cash. Good earner, smart guy, but no clear plan for how to deploy it. No structure, just money sitting there doing nothing. Actually, losing value to inflation every single day. Within weeks, we built a simple, structural allocation aligned with his long-term goals. Traditional assets as the core, crypto as the growth engine, everything in the right wrappers. He went from uncertainty to total clarity on exactly how his money should be working for him.
Definitely more confident in buying into the crypto market and building a portfolio, not being, as I was at the start, influenced by what someone says on social media is the next best thing. I've got, a clear strategy. Good to have that sort of breakdown of monthly investment amount. It's good to have those projections over that sort of 15 years potentially of what a relatively small amount could turn around to. So I think it works well for people like myself who are busy professionals, those busy professionals who are interested in getting it, want to have some exposure to it, but don't know where to start.
Or Neil. Today, Neil has a defined allocation, clear rule for when and how he invests, and a portfolio that finally moves with intention. Not hope, intention.
Initially, when I got this invitation, I was apprehensive. What I found in your program was everything was transparent right from the beginning, which was quite trust building, knowing what you have got and what's your risk profile and how much you can invest and when you can exit. Those are the questions generally as an investor I would like to ask. It was quite educational, so it's trustworthy and educational, and I feel confident doing this probably on my own.
These aren't outliers. This is what happens when you combine a proper strategy with discipline to execute it. So let me bring this all together. If you're starting or optimizing your investments in 2026, here is the framework. 1. Lock down the foundation. Max your ISA. Optimize your pension. Build a globally diversified core using quality index funds. This is non-negotiable. This is what every serious investor in the world does. 2. Add the growth engine, a deliberate, quality-focused allocation to digital assets. Size appropriately for your risk profile. Not a gamble, a strategy, using the asset class that has outperformed everything else in 10 of the last 12 years. 3. Get a plan, not a vague idea. A real plan, what you own, why you own it, how much, in which accounts, and what you do when markets move. The difference between investors who build wealth and those who don't isn't intelligence, it's structure. Look, I built this framework at HSBC for people managing tens of millions. The principle don't change whether your portfolio is £50,000 or £50 million. Diversification, quality, tax efficiency, and now a growth engine that the smartest money in the world is already using. If you found value in this, do me a favor and like the video. It genuinely helps the channel grow and let me keep making content like this for free. And if you're watching this thinking, I've got a portfolio, but I'm not sure if it's actually set up properly, here is what I'd suggest. Send me the word review as a DM on Instagram. My handle is TheoVoucher. I'll personally review your portfolio for free. I just want to make sure you're not sat on a bad allocation for years, losing time you can't get back. Compounding works in your favor, but only if the structure is right. And for those of you who want to go deeper, who want to work with me one-on-one to build and manage this properly, There is a link in the description to see if you qualify for my private mentorship. The best time to start was yesterday. The second best time is right now. I'll see you on the next one.